Okay. Okay, so we have a smaller class this semester for this. We've got a lot in online scheduling in the 8 o'clock class, probably deterred some. But, so a lot of them on the online will be hearing you. But, this is Keil Roehl, and he is with Adams Bank and Trust here in town, and there are many different branches. It was like a small startup, or you can explain a little bit about this. Okay, thank you, and he's gonna talk to us about monetary policy, the money supply, and banks, how they work. Okay, thank you.
Probably the most exciting thing you can do at 8 o'clock in the morning.
Actually, it will be interesting hearing from you, rather than from me, I'm sure.
So, like Kathy said, I'm Keil Roehl. I'm a loan officer, or my technical title, I think, is Vice President of Ag Banking here in Colby for Adams Bank and Trust. But we are a Nebraska-based bank. It's family owned by the Adams family. We sing the song.
Yeah, that's what I was gonna say when you said.
But let's see, I've been with the bank a couple of years now. 22 branches from southern Colorado, like Garden of Gods, Colorado Springs area, all the way up to Greeley, Fort Collins, and then Ogallala, Nebraska, Imperial, North Platte, $1.6 billion in total assets. So we're a fairly decent sized bank. We're not quite competing with JP Morgan Chase yet. They're about 30 trillion or something like that.
Oh, seriously, wow.
So from a banking standpoint, we are still a small bank, but anyways, we have a pretty diverse portfolio of farms and hotels and all kinds of stuff across the.
What, did you say farms?
Yep.
Oh, I didn't know that.
I primarily work with farms and don't use pellets.
Do you want it to go on the slideshow? Is that what you're wanting? Okay.
But no, I'll just run through these quickly. If you have any questions, please stop and ask. But just talking about monetary policy, money supply, and the role of banks. A lot of this is, especially monetary policy and money supply, is a really hot topic right now, with directly involved with inflation and interest rates and stuff like that. So I'm going to start with the role of a bank. The banks, they serve lots of roles, but primarily what a bank does is it creates an efficient market between borrowers and savers. If you have extra money, you give it to a bank, they will pay you some kind of interest for that. If you need money, they do the opposite. They will charge you interest and give you money. We all have standardized terms and agreements. We're highly regulated. That way we don't charge too high of interest or do unfair things, hopefully. And also essentially what happens is we are generating a market interest rate for borrowers and savers. If you just reduce the whole economy to CCC campus, if you had extra money, you would have to go around and ask everybody, hey, I have money, what would you pay me for interest? And how would you ever know if it was a fair offer, if you were ever gonna get your money back, and all of that? Or if you needed to borrow money, you could ask everybody and say, hey, I need $100, what kind of interest, what kind of terms? Well, how would you know you had a fair loan rate? Banks set that. We have been through competition. All of us, we have to compete with everybody, and that should theoretically drive the cost down. We don't have the ability to get together and tell everyone, and we don't call Western State Bank, B Bank, and everybody else in town and say, hey, let's raise our interest rates and lower our deposit rates.
Wouldn't that be illegal?
Probably, but it would quickly.
Collusion?
I mean, you could. I mean, theoretically you could, but immediately another bank would step in town
Yeah.
and take us out. So there is, and every bank has different things they like to do. Some are heavily into agriculture, some don't like ag, some really like hotels, some don't like hotels. It's just a kind of who's in the bank and what they're used to. A bank financial statement, if you guys have done any financial statements, everything a bank does is backwards. When a customer gives us a deposit, that's a liability. That's like a loan for you or I. We have to pay our customers deposits back. They deposit $100, come back the next day and we'll take $50 back. We have to pay that to them. It's a liability to a bank. our loans are assets. That is how we generate our income. And then our profit is derived from the difference between what we charge on our loans and what we pay our savers. So if our 1-year CD rate's probably around 5% right now, I'm gonna want to probably put 3-4% on top of that, so I might have to charge 9% interest, because if you're wanting a 1-year CD, I'm gonna pay you 5. So that could earn about 4% on that. Bank liquidity is very, very complex, and this is one of the hottest topics probably going on right now that is a concern, or people think it could be a concern, but maybe it is, maybe it's not. We worry about the banking system all the time. I'm not going to dive into all the details, but it is very interesting if you like that stuff. But because we have to pay back most of our deposits, if we have a checking account, we have to pay that back at any time.
Yes.
But we're also taking some of that money and loaning it out, and we could be loaning it out on a 5-year loan with annual payments. So we have to balance knowing what we think is going to come in and go out of our checking accounts on a daily basis, plus what our loan repayments are going to be on a daily and weekly basis. And it's very difficult. I mean, we could have an agricultural loan for farm real estate, could be a 20-year loan with annual payments. So I could loan $1 million with a payment of $110,000 every year, but to loan my $1 million out, I've got to have $1.5 or $1.2 million worth of deposits sitting around somewhere. And if all of our customers come in wanting their deposits back, there is the possibility that we would not actually have the money. It's called bank run.
Yep.
Theoretically, it can happen, and it does happen. It's not going to happen, but state nation.
I don't know, do you mind?
Go ahead.
Okay, and would you welcome student questions if you have them
Yeah,
along the way?
just throw
Okay,
some.
I thought so from last year. So on the bank run, back in the 80s, I don't know if you're old enough to remember, but they
Oh, yeah.
had some of that.
Well,
That happened.
So about this time last year with Silicon Valley Bank, if you guys were reading the Wall Street Journal every morning. The Silicon Valley Bank went down, I think it was March last year, and they had a run.
Yeah.
And what they figured out was that the customers figured out that because of the loans and other investments that the bank had made, that if the bank was forced, it was mainly the investments, if the bank was forced to sell those investments, the investments had gone down significantly in value, and they would not be able to get their money back.
Right.
What happened was people started taking their money out en masse, and the bank couldn't make it. Now, we had the FDIC that came in, took over the bank, and funded 100% of all the deposits.
Oh, they did?
They covered it all.
Even over 250,000 limit?
And that was
Wow.
kind of a,
Ooh,
that's controversial because
yeah.
it was expensive, and I can't remember the numbers, it was in the billions. But the reason they did it was to prevent contamination, which is if one bank goes down, then I worry about the next bank. And so by the FDIC stepping in and covering 100% of all deposits, the rest of the market kind of calmed down and said, okay, well, if the FDIC is going to step in, then I don't need to worry about my bank. So
the confidence of the consumer.
Customers still have confidence in this. The biggest difference between the 80s bank runs and now is our phones. So, in the 80s, you had to physically go to the bank and get your money out. And if you were traveling and you were across the nation, you couldn't do it. Well,
Right.
I can take money out of my online savings account, deposit it in any other bank within 2 hours.
Okay.
And so the rate at which the runs happened on SVB was not, they were not prepared for that. That was probably the thing that took them out, was actually the speed at which it happened instead of just the run. If they could have gotten, if it would have happened over the course of a week or 10 days, they probably could have done some things differently, but it happened so fast that they could not stop it. So, and we had runs on banks back in 08, 09 during the financial crisis. They weren't nearly as bad.
That's gonna be a problem.
Oh, it goes to sleep?
Yeah. So, back to the liquidity, but we borrow short, we borrow from you on a daily basis, and then we loan it long-term to the farmer on 20 years, and that's an extreme example, but that's what puts some pressures on us. Other bank assets, we invest in bonds, typically government bonds. They're typically very low risk, and will have smaller returns. Right now, a 2-year government bond's probably paying around 4.5%. But that's also very nice for us because theoretically, we don't have any risk in our 4% return with the government. So when I'm basing my loan rates, if I need to earn 4%, and I'm starting off at 5 based on our CDs, 4% is going to give me the same return as a government bond, and that doesn't involve having Keil Roehl do any paperwork.
That's true.
Just go buy it, and it sits there and it earns money. So it's, again, I'm oversimplifying everything. And then we also have reserves on our balance sheet. It's a set amount of money that we cannot use to purchase assets. Those reserves are used to buffer against liquidity shortfalls and other things. We also have money set aside to cover potential loan losses. But when you hear or listen about the banking system, our reserves, theoretically, we're loaning, rule of thumb is 90% of the deposit up. So if you put a dollar in the bank, I can loan 90 cents out of your dollar.
And that's by regulations, right?
Yeah, that number is heavily regulated. Banks will run on that different, depending on where they're comfortable, what their market is, but just standard rule of thumb is 90. Because of regulation, competitiveness, and the risk within the banking system, we have seen a large number of banks decline since the 50s. You can see we peaked here in the 80s, but then we had the very high interest rates. So when I worked with farmers that were in their 30s and 40s during the 80s, they were paying upwards of 18, 19, 20% for their farm loans. And when I'm still able to charge around 9 today, CDs we're paying in the 15 to 16% range, which we're at 5. But that did cause a lot of consolidation within the banking industry. Now you can see that the number of branches increased throughout that time frame. We lost a lot of branches, but we've actually seen a decline in branches since the 08-09 financial crisis, and a lot of that is because of these. I have a Goldman Sachs Marcus is the name. It's an online savings account. There is no branch.
There is nothing.
I think I could talk to a person if I wanted, but it's all electronic. It works great for me, but as a savings account, but unfortunately branches require people and are expensive.
Yes.
So
Can I ask a quick question about that? So the online banks, there's a lot of online banking options. Is it important to kind of research before you deposit your money in? Or would any of them be okay? Are they FDIC insured?
I would say if you have an FDIC insured bank, it's probably, as long as you're not going over 250,000,
Right.
you're probably
Okay.
fine. If you're putting your money in a place that's not FDIC insured, is not a bank. It is something
Okay.
else.
Okay.
I just, for cash savings account, if it's not FDIC insured, I'm not interested.
Okay.
I would, once you go, we go, if you can get, we'll pay 7% on your savings if you put it here, but it's not FDIC insured. That's not a bank.
Right, okay.
They're doing something different with the money, and if you read the asterisks and all the fine print below, there's probably gonna be a risk of loss principal.
Okay, good.
So.
I mean, not good, but good to know.
Yeah. So, money supply is the thing we are talking about right now a lot. We're trying to potentially reduce our money supply to slow inflation down. This is regulated by the Federal Reserve. It is the total of all currency and other liquid assets on a specific date. This doesn't include stocks or anything like that. This is specifically in one, which that's the number that we talk about, that's money supply. That's the money in your wallet, in your cash registers, that whatever store still has cash registers with money in it. Bank vaults around town. It's stuff that is going to be in and out of circulation at any point in time. Our checking and savings account are also included in there. This is money that gets moved throughout the system on a daily basis. I go to Walmart, I make a payment, I buy $100 worth of groceries with my debit card, that comes out of my account, it goes into an account at Walmart, so that doesn't change the money supply. It just moves from one account to another. That's M1. M2 is, people look at it quite a bit more, actually, it's got a little bit more stability in it, and it adds all of M1 plus short-term CDs, 1 year or less. They also, I think, are under $250,000. If we have a CD of $500,000, I don't believe it's in M2. And then bank money market accounts. Those two specific items are dollars that we expect could enter circulation within the next year, but we don't expect them to happen tomorrow. And the reason that they don't include the very large CDs of $500,000 or $1 million, or maybe public funds, is that money doesn't typically ever leave those accounts. If I have $500,000 in a CD, that money typically stays in a CD for a long time. It's inheritance or it's just a savings that we're not going to spend. The short-term CDs, typically those have a purpose that we're going to use. We also have M3, and that's what picks up the very large time deposits, money markets, and other large deposits. I suppose Apple would fit in there. They have $61.55 billion in cash. I should have updated this. Berkshire Hathaway has $189 billion in cash. Berkshire Hathaway has more cash than Elon Musk's net worth.
Wow.
That's a lot of cash, $189 billion. It's a lot of money. It's awesome. M3, we don't actually calculate it by the Fed. There's some economists out there that still calculate it. And it's also important to know that there's not actually you can't look up a textbook definition that says, hey, we agreed on exactly how we're going to calculate these numbers. Each economist or group kind of has, well, we're going to include this, but not this, but it's relatively the same across. So M1 money supply, this is over the course of, since we've been tracking it, the first thing you want to keep a reminder of is this is not adjusted for inflation. So this would look drastically different had we adjusted it for inflation. I should have probably put that one in here. What it would not have done was change anything about COVID. So this was the COVID pandemic, and we talked about all the government spending and the PPP loans and all of this stuff. That is the M1 money supply from the beginning of COVID to about, I think it's about 18 months worth of time, if I remember correctly. Don't want to dive into politics, but I do believe that this was Donald Trump, and then this was Biden. If you just want to look at, and I'm not picking on either one, but we pushed a huge amount of cash into the system very rapidly. I stayed up till 2 o'clock in the morning for about a month straight doing PPP loans for farms out here, and we were loaning billions and billions of dollars daily out the back door for PPP loans across the nation. It was
So PPP, I can't remember what that stands for. PPP, that's okay.
That's
But
Paycheck Protection Program.
so it was basically trying to keep businesses afloat.
Yes,
During a time
to
when-
qualify for a PPP loan, you had to have an economic hardship during COVID, and you had to not fire your employees, and you had to pay them and prove it. It was a one-page application,
Oh, okay.
so
It was a very quick application process.
very quick, very rapid. The SB, it was administered through the Small Business Administration. They made more, by the first round of PPP loans, they made more loans in 2 weeks than they had done over the consolidated prior 14 years. It was absolutely massive. We did, what GDP was around 20 trillion, I think that's where we were running at
Okay.
that time. And I want to say we did we do 2 trillion?
Oh, my goodness.
Or 1 trillion? It was, or maybe it was 900 billion. I can't remember. It was a lot of money for the people. A lot. And this, we also got during this time frame, they were sending, what do we call them, stimmy checks.
Yeah.
We were getting
The
federal.
stimulus
just
checks.
getting money deposited in my checking account every month. And, bought a Peloton bike with it, obviously still use that quite a bit. So, but there was just money went everywhere very, very rapidly. That is.
And it was kind of an artificial situation, right? It wasn't the economy that was generating it.
Yeah, so that would have been in your GDP calculation, that would have went straight into government spending.
Right, okay.
So, and you could stand up here and debate whether all that was necessary. Yeah, when we look back and judge and make decisions on whether what we did was necessary or not, it's not. We have to be careful with that. Like with anything in life, we know things today that we didn't know at the beginning of COVID.
Right.
And at the beginning of COVID, there were a lot of people dying, and we didn't know much about it. And we were terrified that this was going to be an economic crisis. So you can't unknow the things we've learned since then. But at the time, it probably made sense to do what we did.
They were trying to keep businesses afloat so we didn't go like into a deep chasm.
Because they shut the economy down.
Yeah.
We could not go out to eat. And then all of that money flow through the economy just stopped. And we depend on, if I don't go to Walmart and buy groceries or go out to eat and can't pay the waitresses, can't pay the bartender, they can't make their loan payments, the economy just has to keep going. And that is the reason they did that. Who knows if it was good or not. Great financial crisis. Or GFC, the 2000-2008 banking crisis is right there, 2008, 2009. Now, again, this, by stretching that out all the way from 1959 to 2024, does some weird things to the graph. So if you just break back here, the decade centered around the great financial crisis, we went from 1.3 trillion in one to 1.5. And then ended at 2.8. But the thing to remember is, so then we start off here in May. This is the chart. The scale changed significantly. This is down here now, and that's what we did
Oh my goodness.
in COVID. So just breaking it off into a more of a relative time frame term. And I can remember I was in college and just getting my first job here in Colby during this time frame. And when we spent all that money, we were going to have 1980 style inflation again.
Yes.
That did not happen.
Good.
And we're not out of the woodwork on inflation by any means. This one might be enough to do the trick. So
Over here.
yeah. It's a lot of money.
So our government went into debt basically with all the stimulus.
Yes.
Now with the loans, that should be paid back, right?
Well, so
Or is it forgiven?
Well, so PPP loans were just, I spent a month preparing them, and then after that, I spent a month forgiving them. So
That's what I wondered. They were.
So that we pay back. A lot of the M1, where that came from is the Federal Reserve, I got a slide here if I remember correctly. They went into the bond market and started buying bonds. And I think I've got a slide, but that's really where the money came from And I've got a slide in there, I'll kind of explain how that came about and how they pushed money into the economy.
Okay.
This is M2 real quick, from 1959 to that, looks like it should be 2014, but hey, or 2024.
Oh.
So you can see M2 is more stable of a climb, peaked out, and the goal is to bring M2 down through the increase in interest rates, but we've kind of stabilized. This is the last 20 years of M2, so you can see the bump in M2 during the Great Financial Crisis, and then the bump in during COVID, and the subsequent tapering off. And if you break this off into the last few months, M2 is actually climbing a tiny bit. Depends on who you listen to. That's bad, that's good.
Yeah, we don't know. I have a graphic right behind you where the little guy is standing on the edge of a cliff.
Mm-hmm.
There's a lot of uncertainty as to what's going to happen.
There's always uncertainty.
Yeah.
I mean, and we just got some things that are so far out of the normal parameters. We'll see a chart on Fed funds right here in a while. We stayed at zero interest rates for so long.
Yes.
We were addicted to zero cheap money, and we like to go back, and there's a saying, history doesn't repeat itself, but it rhymes. Everybody's always comparing the 70s and the 80s inflation cycles to what we're going through today. Maybe we'll repeat it, maybe we won't, but fundamentally, the economy is so different today than what it was in 1972. We have trade, we have Temu or Amazon, and we can buy stuff from other countries and bring it over here. In the 70s, we didn't have those options, and so the economy is much more global now than what we had in the 70s. And then also the other thing is that the information flow is so rapid. We know instantly, hey, they had, from the farm side, hey, they're having monsoons in Argentina today, so now we don't think we're going to be able to plant corn down there, and that affects our corn price right away. Where you back up to 1950, we could figure that out eventually, but it wouldn't be now. It would be a week or 10 days. So imagine having to get your news through a newspaper.
I remember.
Or the New York Times. To know what was going on in New York, we would have to print a newspaper in New York and ship it out here. Well, probably a week. So you're a week behind time, and that fundamentally alters everything within our economy.
Or you got a weekly magazine, like my dad. He'd get U.S. News and World Report and Newsweek and things like that, just so he could keep up on what was going on in the world.
And those were on what happened.
That's right.
Now
Past.
we live in a world of what is happening.
Immediacy.
So we know exactly what's happening. Money supply effects on the economy. An increase will stimulate investment and consumer spending, thus increasing GDP. When they sent the government checks out during COVID, to me, I bought a Peloton bike. So I had money I wouldn't have otherwise had, and so I spent it. That's what happens. If we decrease it, it's going to have the opposite effect. As money supply comes down, we're not going to buy things. An imbalance in the supply of money and the demand for money will cause inflation. Money is no different than TVs, cell phones, corn. It is a commodity. There's a supply and demand curve for money, and it needs to stay in balance just like any other good or service or whatever supply and demand. It is exactly the same.
And can I say, and basically we've not been in balance here the last few years, right? With the inflation going up so rapidly.
That would be most common. And we're never in equilibrium.
That's what I wondered.
We're always searching for equilibrium at all times. So it's nice to draw the supply and demand charts
Down at the bottom
but we're always those are always moving and changing shapes, and so
Okay.
we will never hit it, it's a theory.
Yeah,
So that's
right.
what I have a master's degree in ag econ, and, there's a lot of theory involved in coursework, and so after you learn all the theory, you gotta get out into the real world and figure out how things are going.
Right.
So,
Mhm.
but the theory still holds. And in theory, I know how to run that. So, and as I mentioned earlier, not all economists agree on the proper measurement of money supply. Managing the money supply, the Federal Reserve does this. It has a dual mandate: maximize employment, stabilize prices. They have two main tools. The first one is interest rate changes. The second one is buying and selling securities. And this is the one that they did a lot of here during COVID, and now then this works together. So we'll talk about interest rate changes first. So that goes directly back to my CDs at the bank. If I'm paying 5% on a CD, and that's what I have to pay, it makes it much more painful to borrow money. So I'm going to have less demand on my loan from my loan customers because they have to pay 9, 10, 8%, somewhere in there. So then I can't take my $100,000 CD and take $90 or $90,000 out of it and loan it out, because the demand for that loan has gone down. And that's how we create money supply, is we have a $100,000 CD in our bank, then I loan $90,000 to the customer, and he deposits it in his checking account or buys something. So all of a sudden, we had a $100,000 CD that just generated $90,000 of money somewhere else. That's how banks create.
That's how they
money.
create their money.
And so when the interest rates come up, we stick money in savings, but we can't loan it out because the interest rates are too high, drives demand down for our loans. And the other thing is, from a bank standpoint, we now have the option to buy government bonds that are paying us 4%. We can just, hopefully Chad and Todd, the Adams, two brothers that are currently at the top of the bank, decide that they don't want to sit back, put their feet on the desk and retire comfortably, buy a bunch of 5% bonds and be done. Fire everybody and close the bank down. That's not going to happen. They're very open. We loan money. That's the purpose of our bank. We are not an investment bank. We loan money.
Because basically you want to help people,
Yeah.
right, in your areas.
So we are, that's where Nathan was my sidekick. We are what's considered a community bank. Our primary role, we feel, is to reinvest into the community. So we'll take your money or investors' money and deposit it and pay you interest, and then loan it to another business in town to help get some, we've got hotels being built and a hospital being built. Hospital's a little above our budget, but
Oh, I was gonna say, that's a big one.
that's a big one.
Yeah.
That was $100 million project. So we would be able to theoretically win about 10% of that project legally. But
About 10%.
yeah,
Okay.
that's that. I think our legal lending limit is like 10 million or something like that. So
Wow, that's pretty big though.
it's enough. So the other way to create money is buying and selling securities. And so what happens is there are banks and other financial people, mutual funds that own government bonds. And instead of, when we drive the rate down, if they're holding a bond that's worth, maybe so today, if I'm holding a bond that's earning 4%, and that's good for 10 years, in 3 years, if interest rates come down, and I've got this bond that's paying 4%, Kathy might really like that idea. So I may have put $1,000 in this bond, but it's paying 4%. Kathy's got $1,000, but her bond that she can buy at that day is only paying $2,000. So she'll actually pay me more than $1,000 for my bond. And that's what the Fed did during COVID and the Great Financial Crisis. People had all these bonds sitting on their books earning 2-3%. And the Fed said, hey, we'll buy those for more than you paid for them. So the bank, we sold our bonds, but now we have money sitting there that we need to invest that's not earning anything. And the new interest rates are 0, so nobody's going to use a CD. And we can't put it in a bond because it's 0%. It is that exciting. But, so they did that and they replaced the investments in the banks with cash. We need to earn money on the cash, so we in turn loaned it out. We said, hey, our option is buying a bond that's not paying anything now with this, or we'll loan it to you for 4%, because our next best option is 0. So that drove the demand for loans up. And then that's where you get money in the bank. We loan 90% of that money out. It goes into another business, and they pay an employee. An employee's like, hey, I got a raise, I've been getting paid, I'm gonna go buy a car.
Right.
They buy a car, they get a loan from another bank, so it just keeps multiplying through the economy. That is how we manage the money supply. We're on the back end of that right now, where they're doing everything they can to keep us from loaning money out.
Oh, they are, right now?
That's the point of
Because the
raising-
interest rates are
point of
high.
raising the interest rates.
They're trying to slow down the spending.
Slow down the spending.
Okay.
And from a bank standpoint, it decreases our willingness to loan money because we have a safe alternative. From a consumer standpoint, from my standpoint, you know, hey, I can earn 5% on a CD. You know, maybe it's okay to just sit on some cash instead of go out and buy the Peloton.
Right.
Because I can earn money on my CD. I can save it. I'm rewarded for sticking money into a savings account. At 0% interest, they don't want that.
What, T?
How much money of loans do you guys have put out in the past, like, a year or so after COVID?
So that's gonna be a good question. So our bank has grown in assets since COVID. I think they were running around 800 or 900 million prior to COVID, and we're about 1.6 billion. So
Wow.
Adams Bank and Trust has been a big growth bank, not through the purchase of other banks, it's been through new loans. I don't know, so if we've gained 600-700 million in total assets, that's gonna include some other stuff. I mean, I'm sure we have more investments, bonds, because we don't loan 100% of everything we have, but 200-300 million for us, I would say pretty easily.
How
Wow.
much have you guys gained back so far?
So from like a profit standpoint,
Yes.
we're doing well. We're getting squeezed a little bit on our profits because some of the loans during COVID, I've got guys with 4% loans on the books, and we actually, like a lot of banks, don't have enough deposits to cover all of our loans. So what we do is we call up Federal Home Loan Bank. They've got extra money, and we borrow it from them, and so we're paying them 5% on those. So I mean, we've got loans priced for 4 to 12%, and we've got deposit accounts that pay nothing all the way to 5. Like, that's where the complexity is wild. But,
Boy.
yeah, if you look at our income statement last year, I think we made $18 or $19 million. So, which is about 2%, 2.1% ROA. If you know that, that's no. Were we at 2? I think we were at 2. So you take 1.6 billion in assets, and we get to earn 2%.
Wow.
It's a lot of dollars. Between 18, 19, $20 million, a lot of dollars. But our margins are pretty skinny. I mean, in reality, you know, our effective margin, if we loan $1 out, we keep maybe 3% of that. So for every dollar we get 3 cents that we have loaned out. So that's why we have 800, 900 million in loans, because it takes a lot of loans to add a 3% margin to keep the bank running. And every type of industry is different. We have if you guys do any financial ratios, our debt to asset ratio is like 90%. We have a $1.6 billion in assets and $1.4 billion in liabilities. If that was a farm, it would be in bankruptcy.
Yeah, I was gonna say, that'd be really rough.
If that was us, a consumer, you're running her tight. But because we have such large income, or such large numbers when we're working with our income figures now, farms happen to be the exact opposite. They low debt relative assets, but the incomes get compressed. So That's why every industry is unique in that standpoint. Managing money, so I think I've covered a lot of this. They change the interest rate, the Fed does, to alter the rates that banks pay to borrow with extra reserves overnight. So when we're borrowing from the federal home loan, we're paying them 5.25. That's the federal funds rate. If you hear the news, they're gonna raise the rates. That's the rate that they're changing. So if we have extra reserves or extra deposits, we will loan money to Federal Home Loan Bank and earn 5.25. We are not, like I said, in that, and I can tell you, I don't know that there's a bank in Columbia that's like that. They're out there, but they're not typically the type of banks that we deal with in rural communities. They serve a different
The
purpose.
federal home loan ones? Is that what
Federal, and that, my knowledge
Okay.
comes off
I don't know
extremely
either.
rapidly after I said federal home loan bank, so.
Okay,
I'm just a farm credit guy.
there you go.
So today that rate ranges between 5.25 and 5.5. We price our loans with a risk. So this is our baseline rate. If we have extra money, we can earn that at the federal home loan bank, theoretically. So we have to put a risk premium on our loans, 3-6%. You're feeding cattle. Cattle are at a record high price today, so there's only one direction for record high prices to go, and that's down.
Down.
Who knows when that's gonna happen, but we're probably gonna have some price premium on that one. If you have a loan on farm ground that you borrowed $200 an acre against a piece of farm ground that's worth $5,000 an acre, there's not a lot of risk in that loan for us, especially if you're a high income person. I probably only gonna need 3% out of that one. It's all risk based. With this, it's very tempting for us to let excess money sit at the Fed. It is tempting. That's how we decrease the money supply. 'Cause there are
Right.
banks that are doing that. When the Fed Reserve was near zero, we had no options but to loan money out. We have to earn money, and so when we couldn't, we had no option, so it's loan it out. And then when you do that, that stimulates the business investment and personal consumption from your GDP. So how did that?
I know, I refer to it all the time too.
And so that's how we increase GDP, is we lower it's vehicles or home improvements or hotels, and that creates money supply, creates jobs, creates GDP. This is the Fed funds rate. And I don't even believe I updated this. Yes, I did, but it just didn't change. So this is from 59 all the way to today. So we have a lot of people complaining that interest rates are super high. Well, this is 0809. This is right when I came out of college. When I got out here, farm credit line of credits were in the 9% range. Farm credit line of credits are in the 9% range today. So
Yeah.
is it that high? I don't know. Depends on what your point of reference is. These gray bars, I guess I never mentioned it, these are recessions. So your 0809 financial crisis here is here. Right here is I believe that'd be the terrorist attacks.
Where is it? Oh, right there,
In
okay.
the early 2000s or the dot-com bubble, I can't remember which one that happened pretty close to each other.
2001, yeah.
Yeah, I think
Was 9/11.
I'm pretty sure this is 9/11 that caused this short recession. I don't know what this one was. I was only about 8, so. And then
Which one?
in the late
Oh, I see.
90s.
Mhm.
I think it was just some aftershocks of this. So when we talk about the 1980s, and I was born in 1984, so I don't really remember the 80s. But the federal fund rate, if a bank had extra money, could put it at the Fed and earn 18-19%.
Wow,
And that's when we had CDs at 18 and 19%.
Yes.
And interest rates about 20. I mean, we had regular interest rates on farm operating loans that are higher than our credit card is today.
it's crazy.
So this is high.
So, can I just mention something? I remember my parents talking about, because I'm older than you, but I remember them talking about the interest rate on CDs was really good. It was very high, like historically, it never had been that high. But the inflation rate was even higher, so you really weren't gaining any ground.
Yes, that's the case. I don't have anything in here about inflation, but as interest rates go up, we're typically trying to tamp down. The definition of inflation is too many dollars chasing too few of goods. So when we go back to COVID, they said it was transitory at the end of COVID, inflation was transitory. What they were thinking was that too many dollars chasing too few goods. The issue was supply chain disruptions, and we couldn't get the goods we needed to buy.
Right.
That was causing the inflation. And once the supply chain things were fixed, that would come down. Probably turns out maybe it was a little bit of both, or a lot of it. But because inflation's definitely stuck around. Yes, inflation in the 80s was 9, 10, 12%. I mean, astronomically higher than what we experience today. It all started, and that's the deal. We are really wanting to get this over with and be done with this, but if you ask my opinion, if we're going to experience this again, we're maybe back in this area. We had
Back in which area?
the 70s.
Oh,
We had really good. We came out of. Well, you had the war. We came out of, and that caused. We had some problems after that. And then we had a huge amount of growth after the war, which after growth we tend to overheat. Had some inflation, had to try to tamp it down. But the theory is we pulled back on the interest rate too quickly. Inflation came back, so we had to raise interest rates again. We stopped too quickly. As it came down, then we had the wage price spiral at the end where I need paid more because my grocery bill's higher.
Yeah.
And it's inflation breeds inflation. So if we are going to repeat any of this, we are a long ways from 17%.
Oh, yeah.
Interest rates. We're still a long ways from 9% from this. It could happen. It could. There's external factors that can happen that we don't foresee. They're called black swans.
They're called what?
Black swan events. So theoretically, the Russia-Ukraine war was potential for a black swan. We didn't really know that was going to happen. Same thing with the October 7th attacks in Israel.
Yeah.
But we've so far been able to weather all of those. And now we're going to that.
And those would be externalities that really impact things.
So we have quantitative easing and tightening, and this is the Fed entering the bond market, like I talked about, buying and selling bonds on the open market. So quantitative easing is when the Federal Reserve Bank purchases U.S. Treasury bills, notes, and bonds on the open market. They do buy corporate debt, some mortgage-backed securities, and other debt instruments. We'll dive into all those details, but what happens is there's a bond market out there that's constantly trading back and forth, just like Tesla stock or Nvidia or anything like that. There's a whole other market of bonds that's always trading. If you enter a new player into the market, it alters that market, and if that new player theoretically has unlimited funds, they can do whatever they want. So they were buying everything. Essentially, they bought everything. They were buying all of it. If you wanted to sell your bond, they'd buy it. That's what happened.
So basically, that took away the market, like correcting itself,
Yep.
and the government intervened.
Yeah, I can remember the micro charts. If you draw in a supply and demand curve, and then you do a government program or government intervention, you will create an inefficiency within your supply and demand, and that's what it does. But we did it intentionally.
Right.
And whether it was good or bad, that's a debate that we're.
I know there's concern about that quantitative easing.
Yes.
Because,
So.
yeah.
And the thing about quantitative easing is it is new.
It's
We've
new.
never done this until 2008, 2009. And so this is only a 15-year-old thing that, so to compare back to the 70s, how do we compare back to the 70s? Because we didn't do QE in the 70s.
Right.
We don't, the Fed didn't have this balance sheet in the 70s. They typically enter quantitative easing when interest rates are near zero. We've already said, hey, banks, we're not gonna pay you for your extra money, loan it out. And banks didn't loan enough out, and people didn't spend enough money, so then they went in and said, okay, we're actually gonna pay you extra for the bonds you have, so you have more money and have to, and just force your hand.
Oh, I see. That's interesting.
So, again, that creates a disincentive to save by decreasing long-term rates. Quantitative easing bonds are, well, Fed funds is tonight, bonds can be 4 weeks to 30 years.
Wow.
And so when they go into the QE, they go into the bond market, they are monkeying with long-term interest rates.
Huh. The long term. Wow.
Covered this, that's purchased, yeah, our bonds are purchased by large investors, banks, foreign governments. They're actively traded on the secondary market, just like any other stock. Fed increases demand, this new market player, we covered that. And then the last one there, they buy the debt instruments from the banks, and then we loan the money out. Oops. Quantitative easing and tightening. Tightening is the opposite. The Fed sells their holdings. Or lets them, they can actually technically just let them roll off, which means instead of selling them, the bond comes due and the government just pays it, or they pay it out and it goes away. That's what's
Okay.
really happening, is they're just not doing that. But if they go in and sell their bonds, and they're probably holding a bunch of zero-rate bonds at the Fed, I don't want it, because why would I?
Yeah,
It's
zero.
not paying anything,
Yeah.
so when they go sell, they'll actually sell it at a severe discount to the market. That pulls money, that'll pull money, because if I go and buy a bond, I take money out of my checking account, buy a bond. Now they can't loan it out because it's in a bond on my balance sheet. We've never actually got this successfully pulled off, so time will tell.
But it's new.
It is new.
Yeah.
It is new. It is very controversial. We don't understand the effects, and like I mentioned earlier, it's only 15 years old, and so we don't know what's going to happen. We can theorize about it.
Right. And there could be those ripple effects that we don't
And
know.
that's the thing that if I get to complain about one thing with anything economist-wise or even government-wise, this stuff takes years and years and years to work through the economy. I was making farm loans at Farm Credit in 2014 for 20 years, at say 5%. That decision was made back here, and that decision is going to carry out and last long into the future. It doesn't just, because interest rates go tomorrow, doesn't change what we did yesterday. And it takes years and years and years. It's called the lag effect. And that's probably the most controversial thing they talk about, is what is the lag effect of an interest rate increase. And I think it's a lot longer than anybody wants to give it credit for. I have a home mortgage right now at 2.875.
That's good.
And those were during COVID. If I was to go buy a new home and refinance that, I'd be looking in the mid-sevens. And
Wow.
you can get 5% all day on a CD at a bank. If I can earn 5% on my extra money and I'm paying 2.875 for my mortgage, it's easy math for
Mm-hmm.
me. I'm not paying my mortgage off. I don't want to buy a new home. I don't want to move, and those have, and that just has a very long-lasting effect on the economy. Resources, Investopedia is where I'm using a lot of that. It's usually got pretty good, information if you ever want to just Google something, and if you're on Investopedia, it's good. The graphs all came from Fred, the St. Louis Fed Bank,
You know about that, yeah.
and I could spend, I nerd out and spend all day on that. CME Fed Watch, I don't have anything new. There's, with money, there's a whole market for money, and they're trying to predict the interest rates. When Nathan and I did this in December, we would have said the market's going, or the Fed funds is going to go down 1.5% by this time next year.
Uh-huh,
And we are sitting at, well, maybe 0.25 now. So, no, I mean, and that's within 4 months. We've gone from a 1.5% decrease in our Fed funds to a quarter point. So, I listen, unfortunately, to a lot of awesome audiobooks from the great courses on Audible. It's very technical, it's boring, but if you like this stuff, it is interesting. I spend time in the summers and stuff helping my family on the farm sometimes, so sitting in a tractor cab, there's a lot to do. And then if you want a good, just personal financial money book, The Psychology of Money is a great book.
okay.
Talks a lot about, it's not technical, it's much more broad. There's a lot behind the scenes in our financial markets that has more to do with emotions and psychology aspect than the actual supply. So,
Interesting.
I was thinking, I fall asleep listening to podcasts about the financial markets, so there you go. That's more of my life.
Well, that's how you keep up,
But,
yeah.
so I think I went a lot longer this time.
Oh.
Okay.
That's okay. I do have a question for you. So with the federal government, they did a lot of the stimulus. That was a huge expenditure on their part. And then they, with all the PPE, they forgave those loans. So a big loss, basically. Our government is going into debt every day in the billions of dollars. How does the government continue to do that? I mean, if you don't feel like answering it, it's okay, but.
Well, so they have the ability to issue debt, issue bonds. 5% for a CD. You can also go on the Treasury Direct website and buy all these bonds I'm talking about. You do 4-week T-bills, they're paying 4.5%. And so they just issue the debt to people buy it.
Okay.
Hey, we're gonna issue this, we don't have enough money. We need somebody to give us that money, so we go and issue debt. So that's how they finance the deficit.
Is it going to be able to continue to operate like that? I mean, you and I, we can't continually get more debt.
But I can't. If any of you guys want to loan me
Oh,
$100,000, you're not.
Yeah,
gonna do that,
gotcha.
'cause I'm not the federal government. They have the ability to print money.
right.
Yes, we do physically print money, but when we talk about print money, it's really debt, issue debt. And will we be able to continue to do that? Yes, until there is a better opportunity out there. So, and again, money's a commodity, the dollar is a commodity, and if you're going to buy government debt, which is always considered the safest, you get your pick. You get to pick United States debt, you can go down to Mexico, Canada, you can go to Argentina, Brazil, China. I mean, all governments issue debt. Japan right now is in a world of hurt.
Yes, they are.
So their currency is crashing in value because they have too much of it
Okay.
and because they issue too much debt. So, and we won't jump into the whole currency conversion, but so will we be able to continue to do that? So most people keep buying it, and we're still, everything's relative. Where else, if you have money, where else are you gonna go with it?
Right. Right. That's true.
So,
If you want a safe
if-
type investment.
And foreign governments very large investment firms are, I say I'm buying government debt, but not, a few $1,000s is different than 34 trillion.
Right.
So, when you're dealing with those very large, entities or governments that are buying that debt up, we don't maybe have to ever pay it back. Maybe we just have to make the interest payments. I don't know.
Yeah, even the interest payments are huge. Are we having to borrow to cover the interest payments? I'd heard that at one point, but I don't know if that's.
That's kind of tough to say. So, we have a budget we have expenses,
Mhm.
and interest is in one of those. And if we're borrowing money, well,
Is it being applied there or
which one
where?
is it? No, we're not borrowing. If we stop national defense spending, we wouldn't have to borrow money to pay our interest.
Right,
Or somewhere it's all together.
yeah, gotcha.
You can't really
Interesting.
separate it out. At least in my opinion.
Yeah,
It depends, right? That's what the economist says, it depends.
it depends, yeah. And there's so many different ways of looking at things, and different economic viewpoints.
And it is, like I said, I listen to podcasts and two different ones, just to get two different.
Sure.
And one of them is, we will be at a complete economic meltdown next week.
Mhm.
And the other one is, if you're not investing in the stock market today, you're gonna be broke in 2 days, because it's gonna go up, to the moon or whatever. And so,
We're already at the moon, kind of.
last week, nobody knows.
Nobody knows.
Nobody knows.
There's people talking about self-correction of the market, and that's where we'll go down.
Yep, yep.
Who knows?
You can't outguess it.
It's so interesting. I know you guys are just excited too. No?
No, I have a quick question.
Sure.
So, my first question is, like, why do you have a savings account online? Like, why did you choose to do it online?
Why did I use the savings account versus the bank I work at? Oh boy. Remember, I work at the bank, right? Wink, wink.
You want me to turn the recording off?
Yeah. Multiple reasons. I've had it for a long time. So I've worked at this bank for 2 years. Before that, I worked at Farm Credit here in Colby, which is strictly a loan institution, no deposits, so I didn't have a checking account. So I had an existing relationship with this online savings. I have kept that. Not that I don't trust my coworkers, but right there, I can, within 5 seconds, look up and if I really, really want to know what all my coworkers have in their checking accounts and stuff like that. I wouldn't do that. But sometimes it's just through the normal course of business. We do see stuff from our coworkers, and I just, not that I'm embarrassed or anything, I just assume them not. I don't want to see my coworkers stuff, so I just keep some of my stuff outside the bank, and they pay that rate because it's an online saving. They're paying me 4.4, and I could eat 2.5 out of the place I work. So
And what is this online called?
it's called Marcus.
M-A-R-C-U-S?
M-A-R-C-U-S. It is part of Goldman Sachs, the Goldman Sachs Bank.
Are they, is that FDC?
FDIC, yeah, oh yeah.
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 Have you heard of Charles Schwab?
Yep.
What do you think about Charles Schwab? I think it's like, they're starting to make more, they're starting to go public with the banks, but now it was once an online bank, I'm pretty sure.
Ask me next week,
Next week.
because I have a brokerage account, so where, I don't really buy and sell stocks, I just invest for the long term in TD Ameritrade. And Charles Schwab bought TD Ameritrade about 1.5 years ago, 2 years maybe. And this weekend, all of my TD Ameritrade brokerage account is transitioning into Schwab. And TD, which is Toronto Dominion Bank, they did not offer any banking services. They were only a brokerage service, so stocks, bonds, mutual funds. Charles Schwab has entered into the banking services. So yeah, I'm considering that. They have checking accounts, they have a credit card. You have to have your brokerage account there, but I have very little concern about who I'm doing business with if it's FDIC insured. I'm probably going to, if I'm picking, if I'm doing something online, I'm probably gonna pick something that's big. Charles Schwab is huge, Goldman Sachs is huge. I mean, JP Morgan Chase is the largest bank in the nation. I think they hold something like a third of, if JP Morgan Chase goes down, nothing else matters.
Yeah.
It is that big, it is that big, so, I mean, we can talk about what happens, but it doesn't matter. Who knows? But, any of the name brand stuff is pretty safe. Now, JP Morgan Chase, they're a completely different bank than what Adams Bank and Trust is, or what Charles Schwab is trying to do, or the Marcus account. You know, I don't know if they would pay anything for the savings account. So
Really, it's really low, honestly.
They don't really need to.
they don't need to, because they are the biggest bank. And if you're terrified of that's a technical term. If you are terrified of banks going down, you put your money in JP Morgan Chase because they are quote too big to fail. So if they go
That's
down,
kind of scary though.
we have to bail them out. There's 5 banks up there: JP Morgan, Wells, Bank of America, Citizen. But don't read too much about the banking industry. You will see that it's house cards.
Yeah,
It runs on faith. It really does.
How much money do you think it costs to run a private bank or to come up with a new bank?
Oh man, to start a bank, I wouldn't have a clue. You know, a lot of like the online savings banks, like the Marcus account, what they are is a large bank like Goldman Sachs, but they want to brand something different because Goldman Sachs has good, bad, or whatever. Their brand has people have an opinion about that. So they created their online division called Marcus, and that separates the branding. So when they advertise, it's Marcus, but really it's backed by Goldman Sachs. And so how much money does it take to start a new bank? I don't know. I mean, Goldman Sachs is fairly good size, so they would have a huge amount of capital resources. Now they didn't lose a lot of money. So Goldman Sachs, Marcus was partnered with the Apple credit card, and that did not work well for Goldman Sachs. So consumer banking and business banking are starkly different businesses. Goldman's a business bank and consumer, and they dabbled in the consumer market and got whipped. But
So
as
it's
long
more
as they
commercial
pay my
focused.
4.4% on it, I don't care.
And how do you guys go about with fraud? Like, I know there was like a lot, during COVID time, there was a lot of PPP frauds.
Yeah, there is a tremendous amount of fraud during COVID, PPP loans, and just honestly on a daily basis, we deal with fraud, check fraud, wire fraud on a daily basis. The COVID, that was tough. We had every time I was doing very small PPP loans, $20,000 PPP loans, and every time I did one, we earned $2,500. And so
Oh, wow.
I did about $400,000 in PPP fees in COVID Bank during that time. So the incentive to close your eyes and sign, and it happened, all those happened so fast that there wasn't that good of fraud detection and prevention until after the fact. And you can't fix fraud after it's happened, because if you took money, it's not like if I'm gonna commit fraud, I'm not gonna steal $100 million and then set it in a checking account, wait to get caught. No, I'm gonna spend it, it's gone. So that was tough. Fortunately, for when I was at Farm Credit at the time, our our chief credit officer had, well, that was the second pass, go around, the PPP had just passed away. And we were in a bit of a tailspin just because of that. It's a real small 24 employees, so. Fortunately for me, I was able to pick and choose who I did PPP loans for. And so if we didn't have a banking relationship with you, or I didn't have somebody inside the building that said, hey, this person is who they say they are, they're legit, it's on the up and up, I just would say that. I had a guy call us from Texas, and he said, oh, I used to buy my crop insurance from you guys. No, I'm not. Go to your bank in Texas. I'm not doing a PPP loan 500 miles or 1,000 miles away. Because from the bank standpoint too, we got paid the $2,500, but we were making those loans at a regulated, well, I think it was 1% interest. But we couldn't hardly borrow the money for 1% even at that time. So the loans, we weren't making any money on the loan. And so if that loan got stuck with us and they didn't pay it back, we still have it. The money left. So we still have that loan on the books. And so I didn't want to have to deal with a bunch of knuckleheads on the back end. But I'm sure, there was a lot of third party PPP originators. People were getting postcards in the mail, and
Oh, really?
I'm sure that was ripe with fraud because they had they were just processing applications and sending them on.
And we need to let the students go.
Oh, okay.
But thank you so much. We'll officially end it. And if you have questions or that, is it okay?
Yep.
They still ask?
Yep.
Okay, all right. But if you need to go on to your other class, that's okay.
Okay.